The stock will be putting out its numbers later today. And speaking of numbers, what a stellar set of earnings from Raymond. In fact, even if you look at it segmentally, they have seen quite a bit of growth in their Q4 numbers, particularly for garmenting, as well as their branded apparel segments, which have done well. And that's pushed the overall margins up 10%. EBITDA is higher 69% on year. And the top line growth is coming at a steady 1,511 crore rupees. But the profit is clearly the number to watch out for, 56 crores versus 21 crore rupees. In fact, let's connect with the management and talk a little bit more about what the outlook is, whether or not they can sustain this sort of a performance in light of what's going on. And is this profit number here to stay? Sanjay Bahl, Group CFO, Raymond, with us on the show. Mr. Bahl, congratulations. It's been a stellar set of numbers, double-digit growth across your key segments. Walk us through the highlights and some of the factors that led to this kind of growth.
Yes, you are absolutely right. We've seen improved performance across our key businesses. If you look at as to what has been the major contributory factors towards this performance, it has really been a sustained investment that we have done in brand, our retail network, coupled with the operational and sourcing efficiencies that has led to the improved performance in our textile and apparel business at a very broad level. It's really the strategic focus that we had on these brands and the strategies that are now giving us the dividends. In particular, our B2C shirting business grew by 32%, driven by channel as well as product portfolio expansion. Price hikes which we took in the last quarter has also helped in better gross margins. As a result, our textile segment has seen improvement in gross margins led by operational efficiencies and the strong performance of the shirting business. The lower raw material prices have also been a contributory factor. The apparel business continues to grow at 15%, and all our key brands have registered double-digit growth. Our strategy on brand positioning has played out very well in the last 1 year, and our growth has clearly now exceeded the market growth rates in the business. Garmenting also, as you mentioned, there is improved performance. There is increased offtake that we saw in Q4 from our overseas customers, and the capacity utilizations have also gone up. With the unit that we acquired last year is also now improving its capacity utilization, and that is also a contributory factor. So these I think are the overall reasons for the improvement in performance.
Sure. Can you tell us about the margin contributions for each segment of the business and what growth are you penciling in for FY17 for these?
See, if you look at a consolidated EBITDA margins, we were able to maintain it at 9.6%, despite what we will call is increase in our brand spends. Our brand spends increased by 45 crores. And we also had an impact on the bonus impact, which was from a retrospective basis, which had a total value impact of 22 crores in the business. So given the additional costs in these areas, we were still able to maintain our margins, consolidated margins. If you look at the textile and apparel segment, they contribute nearly 70% of our top line. So textile segment witnessed margin expansions really driven by strong performance of the shirting and lower raw material prices. And we believe that, given that there should be stability in the commodity prices for next year, and the operating efficiencies will continue. So on the margin front, we expect that these are sustainable.
Can you also tell us a little bit about the volume growth in the shirting business and some of the changes in material costs that you've witnessed? Are you looking at expansion for your retail network? What's the kind of store count at, as well as your same-store sales growth?
Okay, let me first take on the question that you had on the store network and the expansion plans that we had. Now, in terms of the store network, we ended the year with 1,051 stores. And during the year, we opened a flagship store for the Raymond ready-to-wear in Bangalore, which is performing exceedingly well and has exceeded expectations. And we have big plans for expansion of our MTM and Raymond ready-to-wear. This year, we added about 85 stores, and we will continue the momentum going into the next year as well. MTM and Raymond ready-to-wear will be a key focus area for us. Now, the same-store sales growth has been around 3% for us, and this is also against the backdrop of a subdued customer sentiment as well, and also an extended end-of-season sales that we witnessed last year. So that is as far as the store expansion plan is concerned. As far as the pricing environment is concerned, we look at the market scenario remains challenging. However, the raw material prices appear to be stable, and we will take a calibrated approach and take a view depending on demand scenario and how raw material prices behave as far as the pricing decisions are concerned.
Can you also tell us about your international operations update there and also expansion plans in new areas?
As far as our textile business is concerned, we have franchise stores in the Middle East, and we are looking at also expanding this portfolio. But these are based on opportunities and the market conditions, as we see, are also quite challenging as of now, given the slowdown globally. As far as the other businesses are concerned, there is a currency devaluation which is happening in our core market. So there are challenges, headwinds facing the export markets. This year also our export performance, there is a decline from 23% contribution last year to 21%. So export will remain a challenge.
Now, you've talked about some stake sale in the auto component business. What is the environment like that in this segment, and where do you see it headed?
In 15-16, we divested our forging business, which was a loss-making business, and we've taken an exceptional hit of 35 crores in our results for last year. In the auto segment, we see challenging market conditions, especially in the commercial vehicle segment market. All the major customers, overseas customers that we have, also facing challenging demand scenarios due to the construction sector and the mining sector being impacted globally. However, we are currently focused on growing the business by adding new product categories and new customers in the passenger vehicle segment. And we are also focusing on stabilizing the business and restoring profitability through cost reduction initiatives, focusing on the segments which we expect will grow in the domestic market as well.
Let's talk about your denim joint venture business that degrew by 4%. What was the leading cause of the same, and are you looking at any capacity expansion plans in this segment?
See, the denim we have currently the 4% dip that you see is on account of the commodity pricing. It's a B2B business, so it's largely driven by commodity prices. So there is an increase in profitability. However, the turnover has shown a dip. And going forward, we've added capacities. Denim, the demand outlook is likely to remain stable, and we are likely to see revenue growth coming out of the denim business through better utilization of capacity.
Okay, and finally, walk us through what the guidance is for FY17.